Hello traders, this is BHI Believe. Welcome to my channel. In today's video, I'll be teaching you a very simple strategy that you can use to trade the volatility 75 index and every other volatility index or indices available to you. This strategy is actually very simple and it works very well. I've been using it for a number of years now and I've been able to perfect it and fine tune it to a very high level and a high degree. So make sure to subscribe to this channel because I'll be uploading several other videos like this one. So you want to be subscribed to this channel and make sure you also like the video. Let's get started. All right, so we are going to be going over some lessons and like I said, we are going to be using 3 different tools. And in order to make this particular strategy work best, you have to master each of them. The first one is market structure. You have to be sound with your technical analysis and technical reasoning ability as well. You must understand what a swing high is, what a break of structure is, and so on and so forth. And the particular market structure idea we'll be using in this strategy is the one by ICT. Now, if you don't know what ICT is, well, you have nothing to worry about because I'll be covering most of the strategies, the systems he has developed in this video. And the ones we'll be looking at are the PDRAs only, nothing else. So the PDRAs are just premium to discount arrays. And it is very simple. Okay. So the second thing is RSI divergence. And the third one is super trend indicator. Now, each of these can stand alone as a strategy. But why I am calling this V75 sure strategy is because it's not because it works only for V75. It can work for any volatility, jump, whatever you trade, boom and crash, whatever it is. But this is the most popular one. So let's use this as our case study. And I call it sure strategy because we have 3 different excellent systems that has been put together in order for us to always get that fire trades or fire end trades. Okay, so market structure, RSI divergence, super trend indicator, 3 of them will be discussed in this video briefly. But before we proceed, I want to ask, Forex is fundamentally driven. Everybody knows that, okay, the Forex market is driven by the fundamentals. That is, things happening in the real life or in the real world, like whatever decision is made about the interest rate will have direct impact on the dollar or whatever the currency, whatever the country the news is coming from. So whatever the interest rates, jobless claims, FOMC number, all those things are fundamentals, and they affect and are also the driving factor behind the foreign exchange market. Now the question is, what drives the synthetic indices or index? If you've been trading the synthetic indices for a long time and you've never really asked yourself what really moves this thing, what drives them? Well, the answer is simple. It is not driven by fundamentals or anything in the physical world. It is purely from the name synthetic. Synthetic means something that was created by somebody, that is meant to mimic something that is real. So when they say something is synthetic, it means there is another version that is the real one. So from the word synthetic, it means it mimics the Forex market, but is not affected by the real life factors, such as economic calendar, interest rate, and so on and so forth. So what drives it is simple, it is momentum. And in order to see some success in the volatility trading industry or derivative in general, if you do not have knowledge about momentum and how it moves the synthetic markets, then you need to learn how it moves the market or how it affects the market. This is what I'll explain in this video as well. Okay, so have it at the back of your mind. What drives the synthetic market is nothing other than momentum. So the first thing we'll be looking at is market structure. If you look at number one here, we have market structure, right? So what is market structure? Market structure is just how the market is designed to move, how it is designed to, you know, to move from one point to the other. It's not just going to say, okay, today the market wants to sell, and then it just goes all the way down without any form of retracement or anything. It won't do that. You know, it is meant to, expand, retrace, expand, retrace. And sometimes it consolidates, that is, it doesn't do any of the two. It just moves within a tight space. It doesn't trend. So when you have a market that expands, then retraces, then expands again, that process creates what is known as a trend. And the market that creates such thing is known as a trending market. That is, the market is trending. So look at here, we have market structure here. You can see we have higher high, higher low. Anytime you get a higher high and a higher low, that is automatically an uptrend. And if it is a lower high and lower low that keeps forming, that is a downtrend. When you don't have any of that, then you have a consolidating or a non-trending market. So here, what we do have is a higher high, higher low. Price forms a higher high, comes back for a higher low, goes back for a higher high, comes back, to break the initial higher low. That is known of break of market structure, break of higher low. Can you see? So immediately this happens, it is an interruption in that uptrend that was initially forming, and that interruption can usually mean one of two things: either it is a manipulation of that low and a continuation back up, or a reversal, right? A reversal. A reversal means when the trend changes direction. So higher high, a break of the previous higher low, resulted in a break of structure. Then we can anticipate a reversal, at a sell zone. So this sell zone here, is known as a premium price, and that is why the previous screen I said we'll be using ICT concept. So this sell zone is a premium zone, that is a high price. If it is a buy zone, it will be a discount zone, which is a cheap, low price. So we can bring this into the market. Now we can see from this market we have a high here, a low here, a higher high, a higher low, a higher high. Then we have a break of a previous low here by this. Then a retracement into the sell zone. Then prices are expected to start dropping from there. Okay. So the next one we want to look at is RSI divergence. So what is RSI? RSI is just an indicator that helps you to measure momentum. Like I said, this market is driven by momentum, and you have to understand momentum before you be able to, capitalize on this. It's not just this, even the forex market is also driven by momentum, and momentum is what pushes the market in a particular direction. So we're using this particular simple tool to measure divergence. Now, what is divergence? Divergence means when there's a big difference between two things. That is, if two people are supposed to move in one direction, then one of them decides to move the other, then the person can be said to have gone away, or diverged away from the original plan or the original movement. It's the same thing for the market. If the market is moving one way and the momentum indicator is moving another way, then we can say the price action is not matching up with the momentum of the market. Sometimes it can result in a reversal, sometimes it results in a retracement, sometimes it results in a continuation. Depends on whatever is forming as at that moment. And we have three kinds or types of divergence. Now, look at this blue one up here. That is our price. That is the candlestick. Then the one down here is your RSI indicator. So for the first type of divergence is the regular divergence. Regular divergence means your price does one thing, but the indicator, the momentum reader, does the other. This is also known as an oscillator. Okay, what it does is just to read price momentum. So whenever price makes a high and makes a low, the indicator is supposed to do exactly the same thing. But at any moment where you don't get that exact the same thing, then we can say there is divergence. So the regular divergence usually signify or indicates reversals in the markets. While it can, when it is bearish, it means price is likely going to reverse and start dropping. And if it is bullish, it can mean price is going to reverse and start buying. So in this case, price makes a lower low, but the RSI indicator didn't make a lower low. So this difference results in a divergence. But mind you, this is not enough to say you want to take a trade off of. It's not enough. You need much more than that. So the next one is hidden divergence. Hidden divergence is when this is usually for retracement. That is how I use it. That is a trending market, goes for a retracement. As soon as price gets to that point of retracement or where I want it to retrace to, I always look at the RSI indicator and I want to figure out if we have any form of any divergence there. That is, as price has gone to retrace, thereby creating a. So if we get a, I get price coming into my point of retracement, and the RSI shows me that it has, formed a much deeper impression of retracement. Then I get that is my own hidden divergence. Now, you might not understand with these cheat sheets, but trust me, as we move on, you get to understand them when we start finding examples on the chart. So exaggerated one is when price forms double top or double bottom. So for those who trade double top, double bottom, if you don't know of this exaggerated divergence, then you will take a whole lot of wrong trades. So you can have a double top or a double bottom and then look at your RSI and you are not able to get the same thing. That is, this second leg that comes back to form the second top that makes the double top. On the RSI, it doesn't do that. It forms a lower high instead. Then you get your exaggerated. So how to trade a bullish divergence. So here's an example. If you look at this chart, you can see step one. What's the step one? Step one says spot a divergence between price and RSI line. Look at this low and this swing low. You can see that line. It formed a lower low, right? But if we look at the RSI, we can see it did at that same spot on the RSI, it formed a higher low here. So that's step one. Step two, change your upper band number to 50. Well, you might just keep that one. It does not matter. So step three is we want to draw a parallel line, right? So usually that can signify or indicate where you want to find your break of market structure. Usually you can just use this high. You can use the next immediate high to find your break of market structure. Okay, so the next thing you want to do is once price breaks structure, we want a form of retracement back down. Then we can take our buy trade. It's very simple. Okay, so then you can set your take profit, blah, blah, blah. We are going to be looking into that as time goes on. So here is your RSI divergence settings. So for the RSI settings, for the style, I use black. And then for this particular one, you choose this one here. So once you click on this area, you are going to pick this particular pattern here. I think it's broken, can't remember. So you won't be using just plain line, right? Then you tick and untick, you untick this one and keep the rest. So this setting can only be found on trading view for derivative, not the general trading view. So for the input, I use length 10, keep this one simple, and the smoothing length 14, and then you click OK. So The next one we want to look at, which is the last one, we've looked at market structure a little bit, looked at RSI, and we are now looking at super trend indicator. So what is super trend? The super trend indicator is your easiest way of catching or knowing what the trend is. It works in a trending market, but when the market is not trending, it doesn't work, and I don't advise to use it when you can't figure out what the trend is yourself. Okay, so this tool will actually help you so that you won't be buying when you're not supposed to, or you won't be selling when you're supposed to be buying. You will know exactly in what direction the momentum is facing. So also, if you're trading your volatility 75 and price comes to a point of interest as a retracement, you've been able to figure out the market structure, you've been able to figure out the momentum, the RSI, you've been able to get the divergence. You also want to know what the trend is, right? You want to know if you're trading the direction of the trend. Then this super trend indicator is actually very good. So look at my settings here. So this is what it looks like on daily trading view. You know, this is the settings. So you want to keep it on the 1 hour time frame if you're a day trader. But if you're a swing trader, you want to keep it only on the, so it will be from 1 to I think just 1 to 1. So we don't want it to be from 1 hour to every time frame. So sorry, this is a mistake. You can put 1 here and also put 1 here so that it will appear just on 1 hour time frame. So when you go to other time frames, you don't get confused, because that's a mistake. The mistake a lot of people make. You want to use this on just one time frame. Depending on, if you're a scalper, then you can use them on 1 minute or 5 minutes. Or if you're a day trader, you can use it on 1 hour. If you're a swing trader, use it on 4 hours time frame only. So here is a blank chart of volatility 75. We want to put everything together now. If you look at this blank chart, what really can you say? Would you be a buyer here? You know, a lot of you want to be a buyer here because of this double bottom. Price goes up and then start dropping. Or do you want to be a seller here? How would you know if you're on the right side of the trend? It's very simple. Here is the same chart. And now it looks confusing and all, but I'll break it down for you. The first thing you can see here is the RSI. You can see I've been able to apply all these settings and then it looks like this. The second thing is I've been able to identify my market structure here. That is, I have a break of this low with this movement down here. That's a break of structure. Then I want to take a trade on retracement. The question is, where will the market retrace to? I've been able to identify a fair value gap. What's a fair value gap? Well, my own explanation of the fair value gap is the best fair value gaps are found around that point where the market structure got broken or invalidated. I explained this over and over again. If we look at this particular chart, we can see that between this high all the way to this low, which candle broke market structure? It is this candle here, this one. So that candle usually creates a gap, and that is your fair value gap. So I identify that as my fair value gap, and I want to use that as my entry. Then you can see eventually price came to the fair value gap, and to get my second confirmation, my first confirmation is the fair value gap market structure. I've been able to identify, analyze it. This is 1 hour charts. And the second confirmation is I want to find if there is a hidden divergence. Now, if you are trading retracements, you want to use hidden divergence only. Okay, so hidden divergence is good for retracement. I want to see that, okay, between this high and this low, we have something different on the RSI. You can see we have something different. The high and this high and the high and this high, they are different. This made a new high, while this made a new low. That is hidden divergence. So I have second confirmation that price is going to sell from there. Thirdly, I need one more confirmation, which is the super trend. As long as I can see that price is under the super trend for a sell, then the sell is going to work out. And you can see the super trend is red, price is under it, not above it. Price is under it. We have a hidden divergence, and we also have a market structure, which is ICT fair value gap here. Then you can see, you can take your sell here, sniper entry, price just went all the way down. Another example here. If we look at this chart, between this high and this low, we had a new swing high here, which is this high. So if we match this swing high all the way down to the RSI, it's coincide with this level. And then there's also a fair value gap here. And then price will trace back into the fair value gap. And on the retracement, on getting to the point of retracement, which is point of interest, we can already see hidden divergence has formed. So price formed a lower high, but the RSI formed a higher high. That is hidden divergence. That is confirmation number 2. Third confirmation, price is under the super trend indicator, this red thing. That's the indicator. Price is under it. So those 3 things match up, then you can take a trade. Usually, such trades will go into profits. There's no news that is going to, make it go up. There's no news, nothing. It will just go down. So instead of a lot of smart money guys, they might look at it and say, okay, there's a break of structure here, and they want to be buying when they are supposed to be selling. So as long as price stays under this and all these things match up the way I've explained them, then it is going to be a sell. Here's another example. We have a order block, which is this 1 to 3 candles. This is also volatility 75. And we can see a fair value gap around this order block, right? And at the same time, it created a fair value gap and also another block. 2 things. That's my PDRA. Then we had a break of structure. You can see break of structure of this entire low all the way to the downside. The price traces back into the fair value gap. So fair value gap, order block, that's our market structure. The next thing we want to look at is there hidden divergence, since I mentioned retracement. Yes, there's a high and there's a lower high, but on the other side, there's a high and there's a higher high. 2 things. The third thing I want to know is price under the super trend. If price is under the super trend, sometimes it's just touching it. Then if those 3 things align, I'll be taking a trade for a sell. So here's a blank chart of a trade I took last week. Last week. And here you can see there's not much story, because once you become good at it, you don't need to even apply them before you can easily see them. So here there's no RSI, nothing, but I could already tell. So break of structure, I want the price to retrace back into this fair value gap. To this bearish order block, this green candle here. And then here is the result. You can see this is the bearish candle order block, and then you can see price retrace back, retrace back, retrace back, stay there for a while, and eventually crash down. Now, is there RSI divergence? Was there RSI divergence on this trade? That's an assignment for you. Go and check. This volatility 50. Go and check. Was there RSI divergence here? So let's assume there was no RSI divergence. That means I only used 2 things, that is market structure and the super trend. So price came to my point of interest for a sell and was also under the super trend. So you can see from my entry point all the way to take profits, price was under the super trend. So this is how you can even use the super trend effectively. You can't just be using it blindly, because look at areas here, you'll get it wrong. So you have to use it only with market structure and RSI divergence. If you use it that way, you will usually just get it right. So when not to trade. So if the market is like this, you can't just figure out what the market structure is. You can't find a high, it's just random rubbish. Then just leave that particular instrument and find something else that looks as good as, as clean as this. There's a clean break of structure. There's a, clean markets like this. There's an obvious trend. Now compare this to this. They are not the same. So in situations where you just open your chart and this is all you see, I don't advise to take trades. I advise to look for something that is much distinct and cleaner. All right, that's the end of the video. I hope you learned something. Make sure to subscribe to this channel and like this video, and also check the link in the bio, in the description of this video. You get a Telegram link, my Instagram and Twitter. You can follow me, you can join my Telegram channel as well. So if try out this strategy, if it works for you, come back to this video and drop a comment.